The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of October 14th. If you're new here, thank you for joining us. I hope you find the information helpful. And if you're a returning visitor, don't forget that you can always leave a comment or ask a question, and I'll do my best to incorporate that into our next episode. As always, my goal here is to use my background in economics to help you better understand the markets and the economy around you so that you can make informed financial decisions. With that said, let's hit the books and get up to speed on the markets. The big topic last week was inflation. We saw reports from the Consumer Price Index and the Producer Price Index, both giving us an idea of what inflation looks like in the United States. The Consumer Price Index came in at 2.4% over the last year, which was better than last month, but a little higher than analysts had expected. The core measurement of the Consumer Price Index came in at about 3.3%, which is actually a little bit higher than expected. Remember that the core measurement filters out the effect of food and energy because of how volatile they are. At the end of the day, this was a good report, but gave some mixed signals. So as always, we'll continue to watch and see what next month's report looks like and monitor for the trend. The Producer Price Index actually came in below expectations at 1.8% over the last 12 months and instilled a little bit of extra confidence at the end of the week in the markets as the fight for inflation continues. The interesting thing about the Producer Price Index last week was that we saw the price of services rise and the price of goods fall by equivalent amounts, so the actual change from August to September was 0%. So the change over the last year was 1.8, but in current terms, prices had not changed. This is definitely interesting and something we'll continue to monitor. Last week, we saw our weekly report on the unemployment insurance program, and it surprised analysts with a dramatic increase in the number of initial applications. Some analysts consider that this may be the effect of Hurricane Helene filtering through the system, and the unemployment report this week for insurance claims confirmed this, as the rate returned back down to where it's been for the last few months. We'll continue to monitor this report, as it's possible that Hurricane Milton may have a similar effect in the ongoing reports, and because these unemployment insurance reports are a good proxy for the amount of layoffs that are occurring within the economy from a week-to-week basis. Last of all, taking a look at the markets, all three major stock indexes ended up over 1% higher last week. The Dow Jones Industrial Average and the S&P 500 have been consistently breaking records each week, and the S&P 500 actually broke the record high for the 45th time this year. The NASDAQ last week actually moved within 2% of its own record high. And so as we continue to monitor the markets, the question is, will they repeat this performance this week? And we'll let you know in next week's episode. Last week, we reported that the price of oil was climbing, partially because of the potential Middle East conflicts that were unfolding. This week, we saw the price of oil fall, in part because Israel released a report stating that they would not attack the oil or energy infrastructure of Iran in any initial potential conflict. We also saw reports that the stimulus within the Chinese economy from their central bank may not have been or may not be as effective as initially thought, downgrading some of the oil demand estimates for China. We also saw a report coming out of OPEC, or the Organization of Petroleum Exporting Countries, downgrading their anticipated demand both in 2024 and 2025. And this was actually the third time that they've downgraded demand estimates for 2024. And it suggests that the oil market will continue to see a surplus of excess production or excess supply throughout the end of 2025. We'll continue to monitor these developments and bring you any updates as they become available. As we move into third quarter earnings reporting season, I mentioned last week that the financial sector is one of the first sectors to report their performance. On a positive note, we've seen extremely beneficial reports coming out of companies such as JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup, who happen to be four of the largest financial institutions in the world. All four of their performances exceeded expectations with strong positive estimates for the future. It's an important note to mention that financial institutions generally raise revenue through two major avenues, one being investment banking and the other being what we call net interest income. Investment banking typically consists of providing services to firms such as facilitating mergers and acquisitions or initial public offerings. It's a measure of what we think of as the deal making or the business transactions occurring in the economy. Net interest income is essentially the difference between what a bank charges its customers and what a bank pays to acquire those funds to lend in the first place. This could be the interest rate that they pay to borrow those funds. It could also be the interest being paid to depositors. When the difference between what the bank charges and what the bank pays to acquire those funds increases, when that margin or spread increases, this significantly increases the profitability of the bank itself. What we saw out of these earning reports so far was a significant increase in investment banking and a less than expected decrease in net interest income. The financial sector has struggled in this high interest rate environment, but with the interest rates or the potential for interest rates to fall in the future, most financial institutions are beginning to enjoy or capitalize on that change. Last of all, some reports that came out right before the filming of this video. Retail sales are up, higher than analysts expected, but mortgage interest rates are also up, higher than analysts expected. We've seen a drop in mortgage applications, and one of the things I'd like to do is to encourage you to come back and join us next week, as we'll take a significant amount of time to dive into the housing market. This week, we'll see information on new building permits and housing starts, and we'll be able to combine that with this conversation about mortgages to help give you a better understanding of how the housing market is proceeding. Looking ahead to next week, we will continue to see earnings reports coming out of the S&P 500 companies accelerate over the next few weeks. We expect to see about 125 companies reporting next week, 175 the following week, and about 60 in the first week in November. This is a great time for me to offer a quick reminder that stock prices are fundamentally and primarily driven by the success and financial performance of the company itself. So these reporting periods following the end of a quarter are an incredibly insightful and helpful time for us to get a better understanding of how these companies have performed up to this point and how they expect to perform in the future. These are great indicators for both the stock market as well as the economy in general. Also next week, we'll see updated reports on our leading economic indicators, durable goods production, and consumer sentiment. Last of all, this is an important note. We haven't talked much about the election or the politics, but it is important to note that the majority of states that have early voting or early polling will have opened the polls by the end of next week, meaning that the conversation and the predictions about voting will start to materialize and take shape in actual voting actions. We'll continue to watch this, and we'll bring you any information that we think is helpful or beneficial in understanding where the election may head from an economic and financial market standpoint. That's it for this week. Thank you for joining us. Hopefully you found this information helpful. And again, remember that if you have questions or thoughts you'd like to share, throw them in the comments down below this video and I'll do my best to answer or incorporate them into future videos. If you found the information helpful, make sure you like and subscribe the channel so that you can see updates and notifications for videos being released in the future. As always, we'll continue to monitor the markets and the economic reports to bring you the analysis and the information to keep you up to speed on the markets. Thank you for joining us and have a great week.